Let me begin with a very familiar finance story. Every year, organizations spend months creating an annual budget. Leadership sign off, targets are logged, and everyone feels a sense of certainty. But within a few months, reality starts drifting away from the plan. Costs move differently, demand shifts, and priorities change. By the mid-year, the budget is no longer a planning tool. It becomes a document used mainly to explain why things didn't go as expected. This problem has become even more visible in recent years due to volatile market, supply chain disruptions, rapid technology shifts, and changing consumer behavior. As a result, many companies have now realized that planning once a year is not enough. This has led to a strong shift in continuous rolling forecast. In this video, we'll go beyond theory. I'll show you how rolling forecasts work in practice, how they are built in Excel, how real companies like Unilever, Amazon, and Microsoft move away from the rigid annual budget to more flexible forecasting model. So how annual budgeting works in real life? Annual budgeting assumes that management can reasonably predict the business conditions for the next 12 months. Revenue targets are fixed, cost limits are negotiated, headcount plans are frozen, and capital spending is approved. The budget then becomes the baseline for performance measurement. Take a traditional FMCG company as an example. Sales forecasts are built using the last year's numbers plus a growth percentage. Marketing spends, they are allocated upfront. Manufacturing volumes are logged. Once the year begins, changing the budget requires multiple layers of approvals. So the managers avoid doing it unless it is absolutely necessary. Companies like Unilever have publicly acknowledged that this rigidity created slow decision making. In fast-moving consumer behavior, waiting for the next budget cycle meant missed opportunities or delayed responses to cost inflation or demand changes. Annual budgets also encourage defensive behavior. Managers often pad cost or understate revenue to ensure that they meet the budget. This results in numbers that look precise but are not necessarily realistic. So why companies have started moving away from annual budgets? The shift away from the annual budget did not happen because the budgets were bad, but because they became insufficient. Businesses have started realizing that forecasting accuracy matters more than forecast precision. For example, Amazon operates in an environment where demand patterns change rapidly. So relying on a static annual plan would slow down the decisions related to fulfillment capacity, technology investment, and pricing. Instead, Amazon uses the frequent forecasting cycles driven by demand cycles, operational metrics, and real-time data. Similarly, Microsoft have shifted towards the rolling forecast to align the financial planning with its cloud subscription model, where revenue depends on the usage trends, renewals, and customer adoption rather than fixed annual contracts. These companies have realized that the purpose of planning is not to predict perfectly, but to adapt quickly. So what is a continuous rolling forecast? A rolling forecast continuously looks forward. So instead of planning only for the financial year, the organization always forecasts for the next 12 or 18 months from the current date. Every time a month or quarter closes, the new period is added to the forecast horizon. This approach removes the artificial constraint of the financial year. It focuses on future visibility rather than historical comparison. Forecasts are updated using the actual performance, latest assumptions, and revised business drivers. For example, in case of a retail company, using rolling forecast will update the expected sales based on the footfall data, promotions, weathers, patterns, regional performance every month instead of waiting for the next budget cycle. Now let's walk through how this works in an Excel, because this is where FP&A teams really feel the difference. Imagine a simple Excel model. On the columns, instead of Jan to December of fixed year, you have a moving timeline, say April 2026 to March 2027. This timeline is not hard-coded. It updates automatically. Fixed costs are linked to headcount or the capacity plans. This is critical because in a rolling forecast, cost behavior matters more than the cost categories. Now imagine that after 2 months, the actual revenue comes in lower than expected due to a, say, delayed customer onboarding. In a rolling forecast, you simply replace the forecast numbers with actuals for those months, update the assumptions for future months, and then extend the forecast by adding new period at the end. This process typically takes days, not weeks. In contrast, under annual budgeting, updating numbers mid-year often means creating multiple versions, explaining why assumptions changed, and seeking approvals that slows down the decision-making process. Consider a small furniture manufacturer that supplies tables and chairs to retail stores. Earlier, they worked with fixed annual budget. At the start of the year, they estimated how much they would sell and planned their production accordingly. But customer demand kept changing. Sometimes they produced more, sometimes their inventory piled up, other times they ran short and had to rush to the production. So they decided to switch to a simple rolling forecast. Every 3 months, they updated their sales estimate based on the new orders from the retailers. They adjusted their production plans accordingly. They also tracked the raw material prices and updated the cost estimate regularly. Cash flow was monitored by tracking how quickly customers paid and how long inventory stayed in their warehouse. So within a year, they had less unsold stock, fewer last-minute production changes, and better visibility on cash needs. Most importantly, management meetings changed. Instead of asking, why did not we meet the budget, they started asking, what is changing now and what should we do next? Key benefits seen by the companies. Organizations that successfully adopt the rolling forecast see better cash visibility, faster decision making, and stronger alignment between finances and the other business teams. Finance then becomes a forward-looking process rather than backward reporting. So companies like Unilever reported improved agility in responding to commodity price volatility, while technology firms like Microsoft improved capital allocation and resource prioritization. Common pitfalls in rolling forecast. Many rolling forecasts fail because companies continue using them as performance evaluation tools. When bonuses are tied directly to forecast numbers, managers will manipulate assumptions, defeating the whole purpose. Another major pitfall is over-engineering the model, too many drivers, too much detail, and excessive manual intervention. This makes the process slow and unsustainable. The most successful implementation keep model simple, driver-based, and decision-focused. Annual budgeting versus rolling forecast. Final thoughts. Choice between annual budgeting and rolling forecast is not about abandoning discipline. It is about choosing the relevance over rigidity. Annual budgets may still exist for governance and external commitment, but rolling forecasts are becoming the primary tool for running the businesses. Companies that succeed in this transition accept the uncertainty, focus on the drivers, and empower finance to act as a strategic partner. So in a world that changes every quarter, planning must change with it. Thank you. All the best.